Well, welcome everybody. My name is Rich Harvey, CEO and founder of Property Buyer. Today, I'm very blessed to have Munzarul Khan with us, who's the chairman and founder of KHI Partners. Now, Munzarul's a chartered accountant and he's specialised in all types of amazing accountancy work. He's been in the business for 3 decades, so it's great to have you on board, Munzarul.
Thank you very much, Rich. Look forward to it. Thank you.
So today's topic is talking about tax-effective property investment strategies. Now, during my career, I started off with what I call limited knowledge. And over many decades, I've grown that knowledge. I've attended many courses, read many books, attended many webinars like this. But every time you get the opportunity to add to your bank of knowledge, I would encourage you to take it. It's how you can expand your mind, expand your wealth, and provide more for your family and your friends as well. So, Munzarul, I'm going to invite you to kickstart today's discussion. So today is going to be a discussion around a whole lot of different topics. And then for the second half, I'll be giving a property market update, and then we'll be finishing with a live Q&A session. So if you do have any questions in the audience there for us, on the bottom of your screen, there's a Q&A box. So as we're talking, please feel free to write your questions in there, and we'll try to get through as many of those as possible. And we'll look to wrap up the webinar about 1:40 p.m. this afternoon. So we've got a good just over an hour and 10 minutes to go through, Munzarul. So don't rush, but I'm in your hands, Munzarul, if you'd like to share your screen and let's have a chat about some questions, please.
Beautiful, Rich. Thank you for giving this time. And guys, I can see that there's a large audience, right? There's about 100 odd sort of participants, and I know it's also getting recorded as well. So, guys, I was being asked to do this about half an hour or so in terms of tax effective property investment, right? So, Rich and we were speaking yesterday, and we were sort of saying is that, how do we start the topic? What do we discuss, and what are the areas that we discuss? And it was amazing, Rich, that there were a number of things that we were speaking. So we were speaking that how information seems to be so available at the moment that you almost need to segregate in between the noises to the reality of the information, right? And we were also discussing that you and we've been around for a number of years, and how we sort of say as a bit of a cliche, right, that history repeats itself, but in amazing way that history does give us a whole lot of a learning lesson, and it's for us to pick up those sort of a learning lesson and share some of those learning lesson, yeah? So I'll try to share all of those. Now, I have to start with some standard disclaimers. And the standard disclaimers, guys, is that anything which I share in here are generic in nature. This is, of course, not specific information. I'm not a financial planner. I'm an accountant. So my role is to give the facts and figures, perhaps to some extent in terms of my experience. And one must run through with one's own financial planner as well as the accountant before relying on all of those. Yeah. So, agenda. So, tax-effective property investment. So, how do we manage, right? So, I was sort of thinking that perhaps we start with some of the very basic, right? So, we start with all the way from the micro level of planning, micro level of perspective. What is deductible? What can we do? What are some of the basics that are a tick box? And once we cover this, then we may take a bit of a step back and say that, all right, so we understand all of those sort of basic things, what we can, what we can't do it. But how about we go through and see some of the sophisticated strategies? So what does an investor who's been around for a little while, what are the strategies that the investor sort of utilizes as more from a holistic point of view, so to speak? So we'll cover a bit in terms of macro perspective. So once we go to the micro level as well as the macro perspective, is that I'll touch base a bit in terms of risk mitigation. It's more sort of your buffer, right? It's more sort of saying that it hasn't been built as a house of cards. So everything being built with sort of the right base. And once we get that risk mitigation being covered, we may extend ourselves and say that, well, is tax effective property investment only for a generation? Is it for part of the generation? Is it for our retirement? What does retirement means? Does it end in retirement, or does that go through in terms of succession planning? How do we do tax-effective property investment through intergenerational asset transfer? So we'll try to touch that a bit as well. And then right at the end is that I'll sort of take a step back and I'll sort of say that, well, some of the experiences that I've seen over the years, so some of the clients, some of the wins, some of the losses, and all the different emotions that we've seen, yeah?
Right,
so
sounds awesome.
That's sort of at a high level. Thank you, Rich. Thank you. All right. So we start with some of the basic things, right? As a property investor, is that when one sort of looks through in terms of how do I make is tax effective, we need to make sure that everything which is deductible, which are allowable to be claimable, that we claim them, right? So I purchase an investment property. That investment property is being rented, let's say, for 10 months, 12 months of this particular financial year. All the deductible expenses. So what are deductible? So the interest cost, the amount that I borrowed, and the interest cost which is being associated, that's deductible, right? Council rate, water rates, insurances, any other repairs and maintenance that we've done, all of those things are deductible, right? Gardening, any other cleaning, strata fee, all those things are deductible. Yeah. Where the commissioner comes in is to say that there are certain things which sort of bit of a no-no. So we can't make an estimate. We can't say that, well, we've done some renovation, we don't have the actual substantiation. I believe we've done about $1,000 or so, right? It's not so much this, it's about what you spent, what do you have as a substantiation is what we can claim. So there's no estimation, it's an actual, right? Commissioner also sort of says that be watchful in terms of the private and the business side of it, yeah? So say as an example is that we've got the same sort of the painter who's sort of done a painting and did a painting in my own home, principal place of residence, as well as an investment property. In an ideal world, I should be receiving this as two separate invoices, right? So there was about 10 grand being spent, so 6 grand being spent on the principal place of residence and 4 grand on the investment property, and not to mix it away and say that, well, it's about a 10 grand overall invoice and 10 grand overall payment, and I will do that as a pro rata. So one got to be careful, right, with the private expenses side of it. One area, Rich, that Commissioner gets quite, I suppose, quite touchy in the sense that this concept called available for rent. So a property is being purchased, it doesn't necessarily mean that quite immediately you can claim all the deduction as a revenue. So if, let's say as an example, I bought this particular property for about $1 million, and first 2 months, I'm doing quite a bit of renovation on this property as such. Now, while I'm doing renovation on this property, while there's no tenants and I'm not advertising this property as yet, those 2 months of all the interest cost, all the running cost, is that I can't claim that immediately on the tax return because the property was technically not available for rent. Yeah, I can still capitalize all of those costs and I can claim them when we sell the property, but not quite immediately as such. So be watchful about that property, whether it was being available for rent. And there's some sophisticated rule in terms of what is the definition of the available rule. Now, when we speak about the deduction side of it, there are some non-standard deduction, if I may. So borrowing cost, as an example, is a non-standard deduction. And very often is that, let's say we purchased that property for $1 million as an investment property, and we borrowed up to 90%. And very often we say, well, we borrowed 90%, which includes the LMI. So in reality of it, the borrowed amount is about 87% on that example, give or take, and 3% is, give or take, is the LMI. And the lender's mortgage insurance is that rather than paying that by myself as sort of a cash payments, it very often gets capitalized, right? So $1 million, 900,000 is the loan. You know, I'm sort of paying that 10% plus the 5% incidental cost. Now, borrowing cost is the one very often we miss it because we haven't physically paid it. It's being capitalized on the loan, is that unless you sort of actively sort of raise it to the accountant, the risk of missing this out, right? So while it gets capitalized, it can still be claimed over a period of 5 years or the term of the contract that you have, whatever is the lesser. So 5 years, right? So borrowing cost.
Quick question. On my understanding, obviously you amortize it over 5 years, Manzur, but if you were to sell the property, say after year 3, can you then claim the balance of that 2 years in the year that you sell it?
Absolutely right. And that's where the second part comes in, right? Is that it's that over the 5 years of the term of the contract, whatever is lesser. So while the original term was there 25 years, on that example is that as soon as he sold it, the contract has been finalized, right? So that means whatever the remaining amount, everything can be claimed absolutely at that stage as such. Yeah. Similarly, Rich, is the settlement expenses. So very often we see the tax return and the client has sort of bought it in, say, July and we've done the tax return. There's no council rate, there's no water rate. We go back to the client saying that, where are the council rates? I was like, no, we haven't paid it. was like, no, you did pay it. And all it is that as part of the settlement, it got adjusted. So it could be that the previous owner has paid it for 12 months in advance. And then when you purchased it, that sort of 12 months in advance, it gets adjusted as part of the settlement. So because it gets as part of the settlement, it gets adjusted. Very often we miss it, right? So we need to go back to the solicitor's settlement adjustments for any new purchase as well as new sale to make sure that all the deductions are being claimed. Yeah. So then we speak about the capital and the initial expense. Now, this one is interesting, right? Interesting in the sense that the commissioner gets very mindful of that example, which I suggested, is that the initial cost. So if the property was not available in day one, all the expenses which we incurred are the initial expenses, right? And sometimes we hear from clients' perspective, there's a lot of sweat equity, Rich. So we spend a lot of time, we've done this, we've got that as a little bit of a cheap and done this. How do I claim my own time? You sort of can't claim your own time, right? You can't. But what you can do is that you can get a quantity surveyor to provide a detailed report. And that sort of quantifies in terms of what are the actual expenses and or that we can claim. So depreciation, Rich, I'm a big fan, right? Is to say that, yes, we must consider the depreciation. Rich?
Absolutely. Couldn't agree more. And I'm going to do another webinar with a couple of depreciation specialists at a later date, because a lot of people think that government changed all the rules, you can't claim anything. Completely wrong thinking. Even with older properties that have had renovations done, even if you don't know exactly when the renos were done, you can still claim some building depreciation. They have very clever ways of working out when the renos would have been done and how much you can claim on them.
And sometimes I hear the cost that is that bit of the cost of doing the depreciation, is it worthwhile? And I sort of say, guys, it's $700, $800, $1,000 expense. You can claim that on a tax deduction, right?
Exactly.
So even if it's $1,000, you get 30% back. So you really paid $700. And remembering that this is a schedule that you can utilize for the entire lifespan of the property. It's a one-off cost where you can claim the depreciation. So very strongly guarded and strongly recommended. Yeah. We hear about the PAYG withholding variation, and PAYG withholding variation is just touching this is just a timing difference. Yeah. So rather than receiving a $5,200 refund yearly, is that we go back to the commissioner saying, do you mind if I please get that as $100 per week? Now, one got to be careful, because if the estimates are incorrect, then this is where the commissioner sort of says that, whether there should be some interest and penalties. Now, we sort of know that, right? All the micro level of tax planning, there's so much available information, one knows it. So I take a step back, Rich, and I sort of say, what are some of the sophisticated things that I've seen from the investor side of it? Many. The first thing comes in mind is that you got to buy it on the right structure. If we buy it on the wrong structure, then over a period of time, everything sort of becomes a bit of, not so much as a fallacy, but it almost becomes so expensive, right? So example would be is that very often people come in and say, look, we bought everything on a husband and wife on our both name. Why did you buy on both name? We bought it on both name because we've sort of heard that from a lending side of it, we need to buy it on both name. We need to give our guarantee and the assurance from the lending side of it. It's not true. Your loan can be still on both name, whereas the purchase can still be on an individual name. So some could be on his name, some could be on her name. Why do I suggest this? Because when you buy it on a joint name as joint tenancy or tenancy in common, either way, is that your land tax threshold in New South Wales, as an example, you only get one threshold as opposed to two, right? So why give away that $1 million 75,000 of land tax threshold when all you have to do is to buy that on two separate names, right? People ask the question, do I buy it on trust? Do I buy it on a company? Do we buy? How do we buy it, right? Each structure has its own positive and negative. And the strongest recommendation, that one topic, right structure, that's a topic by itself, right? So the comment which I say, please make sure you speak to your accountant before you sign the contract. Which name do I buy? And this is something which we do on day in, day out basis, yeah? Self-managed super fund, Rich, has become quite prominent and particularly prominent where funding seems to be a little bit harder outside the self-managed super fund. Where it's sort of becoming more attractive is that self-managed super fund has its own funding mechanism, right? So your SGC, superannuation guarantee charges, what it comes in, as well as any other employer contribution, it comes in, the rent, all of those is being taken as a serviceability. So you may find yourself in a position where outside the super fund that you do not qualify for loan, but self-managed super fund, you may still be able to qualify for loan. It's a complete two different
This is
financing.
where a lot of people will underestimate their buying capacity. They might
Yeah,
have 500,000 or even 250,000, maybe a sort of a minimum, but they've got
yeah,
money sitting in their super fund. They don't think they can buy a property, thinking that their serviceability is shot because they don't earning
yeah.
enough. As you say, it's looked at in completely different light, completely independent from your serviceability.
And there was I bought my very first property on self-managed super fund, probably about 13, 14 years ago.
Mm.
We could only get about 70% LVR at that stage. That changed to 72, that changed to 80. There are some handful of financial institute that goes all the way to 90%. Now, do I suggest 90%? In my mind, perhaps it's getting risky, but you can get 80%, right? So the benefit of the self-managed super fund, in my mind, is that the leverage means is compounding impact, right? As long as you manage that leverage. And also the tax. The tax is 15%, 10% is the capital gain tax. After the retirement, there's no tax. And also your asset protection. Few restrictions, such as you can't leverage more than once on each property. You can't renovate, you can't live in there, right? So self-managed super fund is perhaps not for everyone, but it's something to discuss with your accountant. Land tax, Rich. We
Land
hear that
tax, the
question.
bane of my existence. There you go.
Oh, right. The dreaded land tax, as we call it, right? There's no land tax. There is a dreaded land tax.
Yeah.
And this damn dreaded land tax, it increases every year. It doesn't decrease, right? To make it even
At
more.
least New South Wales increased the threshold. I mean, I don't remember, it was only 2 years ago, it was about 760,000. Now it's 1,075,000 in New South Wales. So,
That's right, man.
but
That's
tell
right.
me just quickly, do you remember the number in Queensland and Victoria? What's the thresholds in those states? Do you remember?
Yeah, so Queensland is, each state is different, as you said, right? Because it's a state tax. So New South Wales is 1,075,000. For trust, there is no threshold. In Queensland is about 600,000. For trust is about 350 odd is the threshold. In Victoria is about 300 odd grand. And for trust up to 25, there is 25 grand. There is no threshold. And after 25 grand, believe it or not, you actually pay a surcharge. So at the moment, Victoria is not sort of really helping out to a lot of groups of people. Now, we've seen that on the publication. Stamp duties, land tax, Victoria isn't. So,
but can I just do a little comment there, Manju? I've seen a lot of negative articles about how land tax is killing the whole investment property market in Melbourne. But at the same time, when you actually do the numbers, I own properties in Melbourne as well, but when I actually do the numbers, it's pretty marginal. If you consider that Melbourne's at the lowest point of the property cycle at the moment. So in my mind, and because of these extra taxes, it's putting a dampener on it. That's an ideal time to think about buying into that state to get the upswing. So I think my message to everyone would be, don't not buy just because there's a slightly higher tax. Do the numbers, look at it longer term, and work out what you're going to make from it overall.
But I personally purchased 3 properties on my self-managed super fund in Victoria last year. And when I purchased those 3 properties in Victoria last year, all the land taxes, stamp duties, everything being fully informed, and also the fact that the rental return was lower at that stage was also being fully informed. What's the logic? The logic is that a sophisticated investor always invests in the counter-cyclical market, number one. And number two, a sophisticated investor always looks into the longer term. It's that almost that sort of the invisible hand, as we call it, right, which sort of balances out everything. The fact that we are speaking about the Melbourne and Victoria as such means that over a period of time, the demand sort of increases. People look back and everything gets balanced out. So I'm a big fan of Melbourne at the moment. Yeah. Now, Rich, looking through in terms of CGT, is that a sophisticated investor in terms of tax effective property investment side of it manages the capital gain tax effectively. There is a 50% discount if you hold it for 12 months or longer. But the definition of that 12 months is when you sign the contract, not so much when you settle the property. Yeah. So that's why sometimes people get caught out, right? So we bought that property on 15th of March, 2023, and then we signed it away on say 1st of March on 2024. But hang on, Mansoor, I settled that on 1st of May on 2024. I'm over 12 months. Unfortunately, you are not. It's the signing of the contract. So we got to be careful, right? That's why we get a 50% discount. On Superfund, you get 1/3 discount. principal place of residence as an example, there is no capital gain tax. In a corporate entity, on the other side, is that you pay full tax without having any discount. On the trust is that you've got a flexibility, you can distribute, and arguably you get 50% discount. So capital gain tax is something that you actively measure when you are into that selling mechanism. Then, Rich, we speak quite a bit that do we buy residential property? Do we buy commercial property? Do we buy new? Do we buy existing? Do we buy house? Do we buy unit? Do we buy positive or do we buy negative property, right? And you know what? Every one of them has a merit to its own. I remember our old friend Jan Summers many years ago. I was in a seminar, right? And Jan Summers sort of says is that, sometimes we make things a lot more complex than what they need to. I, as a property investor, I sort of follow just a very simple rule. Buy as much as possible, hold on to it as long as I can, as long as the cash flow is being managed. And I still remember just those 3 sentences, and I sort of say that there is just so much wisdom into those 3 sentences as such.
I reckon if anyone hasn't read the Jan Summers book, even though they're a long time written ago, they are still, as you say, it just simplifies, not dumbing it down, it simplifies that wisdom so strong. And I've adopted the same mentality. For me, I'm not a trader of property. I much prefer to buy and re-leverage, buy and recycle my debt, because that's what's going to provide a greater long-term benefit for anyone trying to build good wealth.
But if there is one thing that I've learned on the property investment, if there is one thing there, is that the time in the market, which is one of those 3 things from Jan Summers, right? And time in the market in the sense that very often we sort of say, oh, we've just spoke that the Melbourne is sort of a little bit down at the moment. Is Sydney doing okay? Is Perth a little bit overpriced or getting overpriced at the moment? Do we really buy on South Australia? Is it slowing down at the moment? You know what? We set aside all of those. We say property investment for a very long period of time. And if we do that over a very long period of time, it all gets balanced out and you do it very well. Yes, in an ideal world, we would love to do the timing, but what's the risk of getting the timing wrong as opposed to staying to the market for longer term? Now, equity and cash flow strategies, there's just so much strategies in terms of equity, right? It's the most typical example that mum and dad sort of having their principal place of residence, quite a bit of equity in that property, draw down the equity to buy the first investment property, draw down the equity from the first investment as well as the principal place of residence to buy the second investment property. Before you know, it goes into a trust. Before you know, it goes into a different entity. So the point in here is that any of the equity extraction, you got to be doing it very carefully, very methodically, as well as having all the substantiation there so that your loans do not get convoluted, so to speak. It doesn't get polluted. And if it gets polluted, then you might lose away your deductibility. But if you do it in the right way, there are some incredible level of, I suppose, compounding that one can do. Now, any tax-effective property investment without risk mitigation is silly, right? So there's many things, right? I mean, the commissioner sort of says that they always have this bug of interest deductibility and what can one claim, right? I mean, typical things I hear very often, oh, Mantrul, I've got this investment property number 2 and I've got a whole lot of equity. Can I draw down the equity on the investment property number 2? Put that money into my principal place of residence. I've reduced my principal place of residence loan now. So all of a sudden, my non-deductible loan has decreased. No, it hasn't, right? Because the deductibility of the interest is all about the purpose. What have we done with that particular loan, right? So if we draw down a particular loan, if you used it for an investment purpose, it is deductible. But if you draw down to repay your principal place of residence, part of it is doing 1, 2, 3, 4, 5, which are personal, then it's not. So we've got to be careful what's deductible, how it is, where it is. Yeah. Commissioner also gets very mindful in terms of some of the repairs and improvements and what's the difference between these, right? So you've got a kitchen as an example that you completely broken down, re-renovated the kitchen. Is it capital? Arguably, yes. You've got a kitchen that you've got few hot water system and a couple of things that it doesn't work, and you're sort of fixing them, then they're probably repairs. Yeah. Any confusion, speak to the accountant. Now, that's sort of micro level again, right? Then we take a step back, and I hear that all the time that, Manjul, your investment quite a bit in terms of property. How about diversification? So surely diversification needs to be taken into account, right? Because that reduces the risk. You've got no diversification, all of your assets in one class. And this is why Rich has sort of say, arguably property investment can itself have diversification. So number one is that you can have investment in different classes of properties. You can buy commercial property, residential property, mix them up as you need to, based on your needs, right? You can buy in different geographical presence, as an example. And I've seen with my 25 years of investment that property cycle almost goes into different level of cycle. Not necessarily all cycles are sort of increasing at the same time. I've seen many times when New South Wales is absolutely hot, right? But Queensland and Victoria is struggling. And I've seen many times that everyone says New South Wales has done it. There's no more price increase ever in Sydney. We'll buy in Brisbane. I was like, there's no such thing ever. It always comes back in history, right?
Absolutely.
But the beauty of it is that if you buy it in different states, you almost having a little bit of sort of your hands into sort of different pies, so to speak.
I think the key message there, Munzrel, is you're taking advantage of different property cycles at different times. So just as we talk about Adelaide or Brisbane or Melbourne or
That's
wherever,
right.
you're taking
That's
advantage. And it also minimises your land tax exposure across different jurisdictions as well.
100%. And then, you buy properties for different reason. Diversification can even go into the types of properties. You may wish to buy a property which is purely income generating. You may wish to buy a property which is purely growth oriented. You may wish to buy a property which has got manufacturing growth opportunity, i.e., I can subdivide the land and create a battle axe plan. You can buy a property which has got manufacturing income protection potential, i.e., I buy a property that I can build a granny flat at the back, right? And arguably, all of those has diversification behind it. Yeah.
Absolutely.
But then we look and we sort of say, all right, okay, so we as an investor, we're buying all of those property in a tax effective manner. What does that mean? Why are we buying it, right? We speak quite a bit, we hear quite a bit with retirement. And I ask the question, what does retirement mean, guys? And, we are all living much longer, right? The ladies are living 87 years old, gents, unfortunately, 83, with a little bit less. But that's sort of our median age, right? So if that is our median age, what does retirement mean, right? Of course, there's no one definition. But Rich, in my mind is that as long as you do what you wish to do, and you don't have to work as a necessity, you may still work quite a bit, but you work as a choice. To me, it's the definition of the retirement, right? Now, saying this, of course, there are some statutory definition, right? After the age of 55, you go into transition to retirement. From the age of 65, you can go into full retirement. From the age of 75, you probably should not be doing any more super contribution. That's what ATO tells us. So what that means is that depending on which stage that you are, you might look into that. Are you into the acquisition stage? Are you still buying? Are you a bit more in a consolidation stage where you sort of say, okay, I've done my buyings. I'm going to just put together some of the properties. Are you into a retirement stage where you sort of say that, well, do I sell it out? And when you go close to the retirement stage, do we look into a bit more on the self-managed super fund because it has got no tax obligation after the retirement? Do we balance them out in terms of cash flow? Do we still have a lot of growth? How do we downsize our principal place of residence at a point of time? Is that a necessity? What do I do with that downsizing of that principal place of residence, and how much more funding that I can put into my superannuation? Now, all of those questions in terms of the property investment side of it, they're all sort of part of it. And then I suppose the area that perhaps I've sort of seen that we get less discussed is the succession planning. And so important it is, Rich, is that, we look into our lifespan and we sort of say that if we don't do it in the right way, our poor kids and the next generation of the kids, they would pay awful amount of tax on the same investments, right? So as a property investor, we need to make sure, my view, is that we got to have wills, right? We got to have this concept called testamentary trust. And you've got a whole bunch of things, power of attorneys, enduring guardianship, binding debt nomination. All of those things needs to be placed in the right way. And if it's done in the right way, then the assets can be allocated back to the next generation in the most tax effective manner. And if you don't do it, tax could be quite a bit. So just to give you one quick example is that if someone were to inherit a property, let's say from mom and dad, when mom and dad bought that property pre-September 1985, that means when that was being inherited, it gets inherited at the market price. Whereas if someone were to be inheriting a particular property after September 1985, it gets inherited at the purchase price. So mom and dad could have bought that damn property back in 1986 for what we know, 25,000, and it's probably sitting at some damn $5 million. Now it's all exciting of saying, okay, I've got a $5 million asset with no mortgage attached to it, until the commissioner comes in and say, okay, so you made about $5 million profit. How about $2.5 million is your capital gain? And you pay $1.25 million tax into it, right? So still 3.75 is pretty good, but it's not 5, right? So that's where the planning sort of comes in quite a bit. So this is where I take a step back and I say, Rich, being in the profession for about 30 years, and our practice KHI partners about 16 years, starting with the Kesha chartered accountant, moving into KHI, there's so many investors I've seen. And it's amazing when I look through all my clients, I can sort of categorize in so many ways. I've got clients who are pure accumulator. They're almost obsessed. They buy and buy and buy and buy. When the bank says he can't buy it anymore, they find another bank. When the second bank says he can't buy it, they actively try to find a third bank, a private banker. What I say to some of those accumulators is that if number of banks are saying that you can't buy it, please look into it carefully. Why? Banks are there to lend the money to you. And if all the banks are not lending the money, don't try too hard. Have a look through. What do we need to do to fall within the rules of the bank? Yeah. I see this renovator who is sort of compulsive renovator, right? It's exciting. I buy property, I renovate, and I sell it. I was like, oh, does it make profit? Of course it does. I bought it for 500,000 and I spent only about 100 grand. So that's about 600,000. I sold it for 800. I made a 200 grand profit. Oh, I don't know whether you made 200 grand, right? Because that 500,000 that you sort of purchased has got a purchase cost to it, right? Give or take is 5% you attach this, right? That 800,000 that you sold it is that there is got a 3% selling price to it, right? And then the time that it has taken you for 1 year, you've got loss of income. You also got interest cost within that period of time. You might have still made a bit of a profit, but it's not as simple as 500 plus 50 and take that away from 800,000. Do your maths in the right way. See whether that is your level of the passion. Unless it is, then perhaps we leave that to the expert. Yeah. Then you've got all those developers, right? And you've got mom and dad developers, and you've got the sophisticated developers. The one which I like is the accidental investor. And you know what? I'm probably the accidental investor. I never wanted to invest in my life. My father is the one who sort of says, you got to buy your first property. And this was back in 1999. I was sort of early 20s. And I was like, no, I'm not buying property. What would I buy property for, right? Because property has got issues, tenant complaints, hot water system doesn't work, carpet doesn't work. It's always complaining. I want to buy shares. It's exciting. Shares goes up by a certain percentage, right? And I now look back and I sort of say, wow, it has worked out. Where I struggle, Rich, is that when we go into the procrastinator and the armchair investors. So I've got this number of clients. Good Lord, if I need information, I call them. They know every single thing about every single area, and they know all the knowledge. They are my educator, right? The only problem is that they know so much that they end up almost paralyzing themselves. They don't do any decision at all, right? And then I go back and I sort of say, you know what? Warren Buffett still says that with all the sort of the big decision that he does, and Charlie Munger, right? Of course, there is a whole lot of his CFA and a lot of his statistics and all the rest of it. But that final decision is still being made with a sense of emotion attached to it, i.e., is about relying on your sixth sense and having that ability of decision making, right? Then I've got this oldest group of family investors. Oh, we buy it together. Brother and sister, we always do it together. I always do it with my parents. Why? Oh, because we can combine all of our resources together. Our loans are 25%, father, mother, brother, sister, right? So 4 of us, we're doing it together. It's like the challenge is that at the moment, while the loan are smaller, and then you've got a higher level of family combined income, I hear it. But if you look through the longer period of time, when you have your own family, the bank will take all the loans into your individual name, and the bank will give only about 1/4 of the income. You're almost going to be paralyzing yourself for a very long period of time, if not the rest of your life. So family investor, I don't know whether I'm a big fan. Then the last two is that I've got the worldwide investor, right? And we sort of say how the world has become a global village now. And there is just so much opportunity in the worldwide. And I've sort of started seeing a number of my investors going into New Zealand, UK. Mind you, it was being done in the past, and sometimes it was being done well, sometimes it was not being done well. There are risks attached to it. One needs to be careful. And my absolutely the top favorite is the Aussie battler, the simple mom and dad investor. And the reason I say the Aussie battler is my top favorite is that what I've learned over a period of time with my investment, it's consistency, it's persistency, which works. It's about just a small winning every single day. That by itself makes it a big win over time. Nothing flashy, nothing needs to be over the board. It's just a little bit of a steps, and that's what the mom and dad investors do. And over a period of time, let the time and the compounding impact to do all the tax effective investment. Thank you, Ray.
That's great. Thanks, Munjul. That's fantastic. Now, you've hit some really good points. I love the way you outline the different demographic of investors. That's going to fit really well into what I'd like to share now. Let me just share my screen. So give me 1 second. Screen two. All right, there we go. So you can see that okay, Munjul? Yeah.
Absolutely.
Yeah, sweet. All right. So I think a lot of you already know about my background. We won another couple of awards this year. So we're up to 47 awards for excellence, Munzra. We're trying to hit 50 this year if we can.
Wow.
That's our goal as a company to hit 50 awards for excellence, which will set us head and shoulders above our competitors. But I guess a couple of things I want to talk about today is do a brief market snapshot. I want to answer this question we get asked all the time. When is the right time to buy? I'll cover off on some price predictions, and then also, like you, just do a couple of case studies. I won't go through them all. And then the best part about our webinars is the Q&A, which I know all of you are looking forward to very much. We've already got a couple of questions going, so thank you for that. All right, so let's have a chat about some different types of strategies. Now, Munzrul, I'm just like you. I'm a big fan. I've sort of categorized them into two types of strategies, what I call smart or risky. You might see that the same strategy appears on both sides of the ledger, and I'll explain why in a minute. So one of my favorite strategies, as you talk about, like the Aussie battler, buy and hold for the long term. Not that sophisticated, but just a simple, good quality investment grade property. Hold it, never sell it, leverage it, and just maintain it, and it will perform outstandingly for you. Once you hold a property for 15 years or even 20 years, the rate of exponential capital growth is phenomenal. It is like, I look back at my own portfolio, wow, that has just gone beyond what I thought it would grow at in terms of a price and what it's worth today. Quite amazing. I'm a big believer in buying established properties rather than buying off plan, because if you're buying off plan, you're paying what's called a retail price to the developer. Whereas buying established properties, you're buying more land content, you've already got a lot of depreciation in there, so you're not paying over the odds for the property. I'm not a fan of flipping because there's just too many taxes involved, and it's very, very dependent on market timing. So unless you're a sophisticated investor, flipping is not a strategy I recommend. Positive versus negative gearing. Again, what strategy is going to work for you is going to depend on your financial situation and what your level of income is and level of risk is. Now, both strategies, if you said Munzrul, can be used to hold an overall portfolio. And I believe, like you, it's good to get a balance of positive cash flow properties that help to offset any losses that you have on a negative geared property. But you eventually want that negative geared property to become positive, and it should over time. You don't want to hold a negative geared property for 15 years. It's going to kill your cash flow. So you should be putting up the rent in doing improvements on it so you get that rent to a position where it's covering itself or washing its face, as we say. Granny flats are a great way to add extra value and also extra income to boost the yield. Doing a renovation, adding an extra bedroom or making it more appealing to bump up the rent is a great way to go. And then building and developing. Now, that's not for everybody. Now, you can see I've put it on both sides there. So if you don't know what you're doing, you just be really, really careful for that. I'm not a big fan of NDIS. I'm not sure what your thoughts are on this, Munzrul, but I've seen actually the Fin Review actually recently did a bit of a survey on a couple of investors that went into buying NDIS properties on the basis they'd get 14% yields. Lo and behold, they've spent $1.4 million buying this house, but they've bought in an oversupplied area. So they're now stuck with this highly specialized asset that they can't let out. So it's a bit like buying a commercial property in the wrong area. You've got
Yeah.
commercial property is a great idea. Yeah, what are your thoughts on NDIS, Manzura?
Mike, absolutely, I could not have agreed even anymore, right? I mean, one can say anything which sounds too good to be true probably is too good to be true. But even if we set that aside, NDIS is being to a great extent dependent on the government support, right? And when you sort of rely with the property investment on a very specific line of government support, that by itself has got a risk, right?
Mm,
And then you got to make sure that whether you are in the oversupply sort of an area, whether the demographic changes, you may have actually bought it in an area which is perfect, right?
mm,
But
mm,
after 5, 7, 8 years' time, is that whole area got changed?
mm,
Then what do you do with that property side of it, right? So there's many ways of saying it. It's
mm.
risky. I don't
Yeah.
have any NDIS in my portfolio at
Mm,
all,
mm.
Rich.
There you go. So there, case in point. So I think when you're coming to choose a property strategy, look at what's going to work for your situation, and don't just do buy and hope. Have an actual discussion with an expert and get someone who's on your side that's going to really help you longer term. So let's have a look now. So the next step is, as I said, which strategy suits me. And as I said, there's 5 things you need to look at here: your knowledge, your experience, how much time you've got to invest in the whole research process, your income and your equity position, your borrowing capacity, and your personal goals. So I say to everybody, just be careful not to run ahead of your own capacity. Think really clearly about the exit strategy that you want before you embark on a purchase. And if you've got equity in your own home, it's a great way to start. A lot of people are paralyzed thinking, oh gosh, I'm putting up my own home on the chopping block. And that was a big thing. I think you remember what Paul Clitheroe back in the day, the very conservative
Yes.
financial planner, said, don't use your own home for any investing. The problem is, if you take that philosophy, you're going to be 50
Yes.
years old before you start investing. You've missed 3 property or 4 property cycles.
Yeah.
So for me, I leveraged the heck out of my first property, to buy a double-digit portfolio, which I've got today. So it's really important that you get the right experience around you to get that investment knowledge. All right, so let's have a quick look at the market. Where are we seeing the market at the moment? Well, there's no blinding news. Blind Freddy will tell you the market's down in terms of sentiment, but it's interesting. We've had really since the last 3 years, since interest rates started to rise, very negative consumer sentiment, which is bouncing around 80 points, as always worked out on a monthly basis by Westpac and the Melbourne Institute. So people are pretty pessimistic. It actually dipped a bit more in June and July, so because of the threat of interest rate rises. I personally don't think we're going to get another interest rate rise. I think it's just going to stay at the same level till probably December or February next year. That's where I think it's going to go. Let's look at auction clearance rates, which have been doing pretty well. Sydney's actually been performing around high 60s, 70% the last couple of weekends. Melbourne was 67, Brisbane 45, Adelaide 75, Canberra 50%. So in my view, the market is holding up pretty well. I attended an auction on the weekend at Lane Cove, missed out. There was about 5 registered bidders all competing for it. So it's a pretty healthy auction market. So quality properties are still selling very, very well. In terms of price movements, so I update these charts every year through CoreLogic, and they're showing that over the last 12 months, we've seen prices go up 2.2% in Canberra and Darwin. Perth's had a massive increase, 23%, Adelaide 15, Brisbane 15, and Sydney 6.3. But what's interesting is the quantum of these increases has been slowing. So the rate of growth I'm seeing is slowing down. So while Perth has been rocketing ahead, it's starting to come back. Same for Adelaide. Brisbane's been actually pretty steady, and Melbourne has been the lackluster performer. So in terms of buying counter-cyclical, I think that's definitely one to watch. We look over a much longer period of time, or we'll look at the charts here. You can see that it has its ups and downs. Just shows you on a more graphical basis how that works out there. Now, if we look at sales volumes, the number of transactions actually happening, we've seen in our own business it's been down the last 12 months, and that sort of tends to correlate with interest rate rises. We tend to see more clients during low interest rate times when people can borrow more, and then it gets crimped when people can't borrow as much. But you've seen their sales volumes, yeah, pretty decent increase in most capital cities. But it's pretty close, as we say, to the 5-year average over time. But the more, actually, no, it's not here. I'll go to days on market is the next one. So this refers to how long it takes to sell a property. And we're starting to see the number of days just slightly increase, not greatly, but just marginally. So Melbourne's gone from 30 days to 39 days. Sydney's gone from 31 to 34 days. Adelaide's probably still very short, and Perth is still very short, and so is Brisbane. So those three cities are actually still they're transacting in a very quick turnaround time. I was talking to my Brisbane team yesterday, and they're seeing on a lot of their properties 10 offers put on one property, like
Yeah.
10 offers. So you have to be very, very smart in the way you pitch your offer so you get to the front of the queue. And my guys there are doing a lot of off-market transactions to win properties for clients and get some good growth. So this is the most telling graph that I want to share, Munzra, with everybody today, is the total volume of listings, which is still down 17% compared to the long five-year average. So this is where we're seeing that we'd always talk about low supply. This is why. People aren't listing as many properties for sale. So it's following a pretty close trajectory to last year, but certainly down. I expect that line will probably improve a bit and get close to the five-year average as we hit spring. I think we'll start to see more motivated sellers, but I don't think we're going to see a lot of majorly distressed. We'll see more stretched sellers, but I don't think we're going to see a lot of defaults, so to speak. And listing volumes state by state. If you look at more total listings rather than new listings, that's on this side of the chart here. As you can see, Melbourne, definitely we're seeing quite an exodus of a lot of investors there from the Melbourne market. Brisbane's got very crimped supply, Adelaide crimped supply, Perth very crimped, Hobart's increased. So yeah, and then Sydney only a very marginal increase as well. So the listing volumes is one to watch, and that changes very much season by season. We tend to get a spike in March and April, so the pre-Easter rush, and then we get a big rush in September, October, and spring. So we'll start to see those numbers improve for the spring market. Now, supply. Let's talk about dwelling approvals. So this chart, which is from the ABS, shows just that we're not building enough properties compared to the decade average for houses. So apartments is way down, and also houses are way down. And this is because construction costs have gone up a lot, land prices have gone up. So a lot of developers are not finding that their feasibilities are stack up at all. It's just not viable for them to proceed. There might be a lot of DAs approved, but they're actually not proceeding until such time as the market figures allow them to proceed. The other thing to talk about briefly is rents. This chart, we're seeing rents rise at almost 10%. This chart got up to beginning of last year. But you can see the rents are starting to taper off a bit and stabilize, or the level of rent increases. So rents have increased dramatically in all capital cities. So the message is, if you're a renter, it's bad news. If you're a landlord, it's good news, but you should be renewing your rents and getting your rents pushed up by your property manager every year. So here's some forecasts. Now, these are the ones that have been put out by Dr. Nicola Powell from Domain. She's the Domain chief economist. I tend to agree with most of these forecasts. Some are a little bit conservative in my view, but these are what I think is the most likely scenario for the next 12 months. This is from July of this year to June of 2025. So she's predicting for houses in Sydney around a 7% increase, Melbourne pretty flat, Brisbane a 7% increase. I actually think that's more likely going to be a 10% increase in Brisbane. Perth around 9%, Adelaide 8%, Canberra up to 4%. So yeah, they're the figures there. So obviously the corresponding median price that we'll see. So obviously the more affordable markets might see a slightly higher percentage increase, but you know, a 7% growth rate on Sydney's 1.6 current median up to 1.7 or 1.76, pretty substantial from an absolute dollar perspective. Fairly similar numbers for units, slightly lower, but all the numbers there. So, you know, 4 to 5% for some of the major capital cities in terms of price growth. So the question is it the right time, or when is the right time to buy a property? And I was talking to several mortgage brokers this morning, asking them what they're seeing out there with buyers and borrowers at the moment. And they all have the same message as me. Don't try and time the market saying that October will be the peak pain month to buy. Don't worry about that. Buy when you've got the borrowing capacity. Buy when your income allows you to buy. So that's the key thing. And I see a lot of people, Munzrul, they'll get a borrowing capacity of say 700 or 750, and then they'll give me a call and say, "Oh, Rich, but I don't really want to spend it all. I want to keep a bit in reserve." And I say, "Why?" "Oh, just for safety." And I say, "That's fine. We can buy you a 600K property, but you're actually going to be better off to buy the best quality of property you can for the money the bank will lend you, because the bank's already put it through the mill. They've already done their assessments. They've got the APRA 3% buffer rate. They're already looking at your credit history to whether you can pay. So for me, I want to borrow as much of the bank's money as I possibly can and leverage that, especially on them in the accumulation phase. So for me, I'm trying to maximize my borrowing to maximize my wealth. That's the approach and the attitude I will take. The other reason I think it's a good time to buy is that we're seeing a lot of other people sit on the sidelines. And as we know, the best time to buy is when others are running for the hills. I wrote an article recently, Munzrul, about when I think the market will reignite. And the minute we get the first rate cut, we're going to see the market reaccelerate. Absolutely.
Yeah.
Cool. What's your thoughts on those topics there, Munzrul? What do you think about borrowings?
Mate, I've written a whole 1 page of notes, and there's just so many different things that we can go a lot deeper. What's interesting is that when you sort of say is that the interest rate is that the first interest rate cut that will sort of ignite. Of course, I absolutely 100% agree. Where I sort of also say is that it's sort of almost that first cut has got a bit of a psychological impact.
Yep.
And it's not so much just that 0.25 changes the world. It doesn't, right? But what it does is that it gives that sort of that psychological sort of the assurance saying that that's it. Now it is signs that the interest rate are not going to increase anymore. It's not going to stay stagnant. It is the first decrease, means that it will continue decreasing, right? And as soon as people get that assurance, then you would see that the prices sort of increases quite a bit.
Absolutely.
Now, I was quite interested when you were sort of saying that what is the prediction of the interest rate, right? And I suppose what's the prediction with some of the prices? And it's amazing because the interest rate prediction seems to be a bit of a butterfly effect, right? Because there's just so many things sort of changes, and when it changes, everything sort of changes. And I would admit that if you were to ask me this question probably about say 12 months ago, I would have said that by now that we probably would have had first decrease. Now that didn't happen because a whole lot of things sort of changed. We understand that the inflation is a lot more stubborn than we sort of thought that it was, and it is stubborn, right? And it's sort of going away, but it's still not going away. Now, saying all of those, I actually agree that I don't know whether the August that we will see an interest rate increase. I mean, you look into the Fed and you look into US, and they're very actively speaking about the decrease of the interest rate, right? And that inflation that we sort of say that it's slightly gone up on the basis of just 1 or 2 months of data. So we got to wait for the new data. We get that, right? But I'll be very, very surprised if the interest rate still increases. I would not be surprised if it has stayed stagnated for a period of time. Your sort of the prediction, whether it is November, December, up until February, I tend to agree with this. I also sort of say that between now till, say, December 2025, I would not be surprised if there is about 1% or so decrease, right? And then one sort of says that, well, what happens to the prices, right? So
yeah, honestly, like I want to do a whole webinar with the chief economist from the HIA, because I do a lot of study on property supply, and I'm going to be writing a lot of blogs around supply issues. But I won't get into it now. But I'm just conscious of time, Munzrul. But thank you for those comments. I just want to finish off with talking about the 7 steps, which I've covered in multiple webinars. But these are the 7 steps that if you choose to buy it on your own, you'll need to do. And these are the 7 steps that we take each client through when they're engaging us for our buyer's agent services. Here's our little pitch on why you'd want to consider using us, but we certainly are able to give you that roadmap and that strategy piece up front to help you identify what is going to be the right strategy for your situation. There's not a one size fits all. We'll also give you access to both on and off market properties and save huge amounts of time and help you get the due diligence done to make a really good decision. As you know, we charge a flat fee, per property bracket. It's roughly between 1.5 to 2% per bracket. If you're interested, we can send you the full details of that. And again, tax deductible cost. So I guess just to finish off, Munzel, before questions, I'll just give a couple of quick highlights. I've got a lot of slides here, but I'm not going to go through every one, just a few quick highlights, and then we want to get into the questions. We've got 9 questions, hopefully some more. This was a great investment we bought for a client just last month. It was a 3-bedroom house in North Queensland on a good block of land. Bought that for $431,500, rents for $595 a week, almost a 6% yield. We found that within 3 to 4 weeks. Whoop, going the wrong way. Sorry. Now this direction. Another one, really similar price for $430, 6.2% yield. Again, an off-market property we purchased. Found a beautiful property here in Hope Island on the Gold Coast for a client. Lovely 3-bedroom townhouse, water frontage on both sides. It's going to rent for $950 a week. So very close to the 5% mark. But great lifestyle appeal. No problem holding that sort of property long term, and you'll have a tenant tomorrow for that sort of property as well. Western Sydney, we're doing quite a bit on. Nikki and our team is getting some great results, especially properties with granny flats, which is what this one was. This had a house renting for $600, flat renting for $450 on a purchase price of $1,075,000. I'll just skip through. So we buy some pretty affordable properties. This was a lovely little 1-bedder that Kevin just bought last month in Merewether Beach. Could be leased out as an Airbnb, but yeah, just literally a kilometre to the beach. Also, yeah, just here's the power of leverage longer term. Oh, the font's gone a bit weird there, but this was one of my properties, Munzel, that I bought for myself back in the Northern Beaches. I paid $850 during the GFC when everyone was like scared running for the hills. I paid $850 for this little unrenovated three-bedroom house with a granny flat out the back. Now I renovated it. I made it into a 4-bedroom house. I turned the 1-bedroom flat into a 2-bedroom flat. So I spent a bit of money upgrading it. Haven't done a lot more to it. It's now worth 2.65 million, you know.
And Rich, how much was the renovation cost roughly, mate?
About 90. The first reno I did was about 90,000. And then the granny flat reno, I got my son to help me. We did it for about 10 grand.
So you spent about 100 grand, right? So your 850, which is say 950, add away some incidental cost, give or take, is about $1 million, if not a bit less.
Yep.
And you've got 2.65 million.
Yep.
Which is the market value, and that's over a period of 14, 15 years. So if one does the compounding return, very strong.
Yep. And I wish I'd bought 6 of these at the time. But anyway, so I was always telling people, buy in the local area and add a flat. And several people did it, and everyone went, no, it's not the right, it won't grow in value. Big phrase, who's going to spend $1 million in that area? Well, you know, to buy a property for $2 million today, you can't find one. It's ridiculous, you know. But I guess the key point is that buying a property with the potential to add a flat or potential to add a bedroom or something down, you don't have to do it straight away. It just enables you to hold the property. It really boosts your yield, you know, down the track. This is a lovely one we bought for an expat in Melbourne, a lovely apartment overlooking Albert Park. And I think we got around $700 a week on a 618 purchase. Beautifully designed. Some of the architecture in Melbourne's just fantastic, you know, really good. I'll just skip through a couple more. There's another one we just did the other day. Yeah, another one we did in Melbourne, purchase price, a little bit lower rent. That's the only thing in Melbourne. You've got to be able to hold the property for a bit longer. The rents aren't quite as strong, but capital growth guaranteed. I reckon it'll be 7 or 8% once we get through this next 2-year period. So this was a great property in the Bayside area, 815, rents for 600 a week. And again, walk to the cafes, shops and train. We also do commercial properties, Munzel. You do need a bit more in your budget. This is a perfect property for one of our self-managed super fund investors. Purchased up in Brisbane, industrial warehouse, 1.575 with a 6.4% net yield, a 5 plus 5 year lease with increases. So look, I'm going to leave it there. Let's have a Q&A time now, and we've got good 11 questions. We will be sending around the slides to everybody. So Munzel, I've got the first question to ask you actually. Quick question. One of my team asked, when is land tax payable in New South Wales? Is it the 31st of December for whoever holds the property?
That's right, Mike. That's exactly 100%. It's the midnight of 31st of December. Whoever holds that land is liable for the land tax for the next 12 months.
And
Now,
do you
if
ever
he's
find that vendors are willing to do a land tax adjustment? Let's say you buy the property on the 30th
yeah,
of June.
yeah.
Like, is it right for the buyer to try and capture some of that land tax cost, or it doesn't really ever happen? What do you see in practice?
No, Mike, that's exactly what I was going to say, right? That if you sort of buy it halfway during the year, is that you always try to negotiate that land tax adjustment. So it's sort of, there is no one rule
Mm.
in the sense that it is part of the negotiation. From my experience, if it's a commercial property, you tend to get more success, and
Mm.
residential property becomes a bit harder, but you do negotiate.
Yeah, perfect. All right, let's jump into the questions. Let's do quick fire. Are subscriptions to CoreLogic claimable?
Yeah, and the answer is yes, as long as you're a property investor and that's being used purely in terms of the your day-to-day management. But if it is a new acquisition, then the answer would be it would be a capital.
Got it. Investment loan package fee or monthly fees, can you claim them? If it's an investment loan, absolutely, 100%.
Yeah,
What advantage to claim depreciation if it is to be accounted for at time of sale? Don't see any dollar value for value. Well, I can answer this one. You correct me if I'm wrong.
yeah,
It's the time value of money here, Munzrul. If you can claim a dollar today, it's going to
yes,
be worth a lot more than claiming a dollar in 20 or 30 years' time.
absolutely, wholeheartedly agree. And just one additional point is that when you do sell it from a capital gain tax point of view, yes, you add that back as part of the cost price, but the fact that you get a 50% CGT discount means that you are claiming a $1 now and you're paying back 50 cents, and that could be 5 years, 10 years, 20 years time. One is the time value, second is the discount.
Perfect. Yes, we'll be sending a copy of the recording on email. Don't worry about that. What does NDI stand for? National Disability Insurance Scheme. So it's there as a national service for people that have disabilities to help them into various accommodation and for looking after them as well. Great session. Name of the book. It's called, I've got it on my bookshelf up here. Let me just
There's,
find it for you. There it is.
there's two books, Rich.
There we go.
One,
Look, I've still got it on my shelf, mate. Look at this.
oh, which
Look at
one?
this. Building, well, Jan should give me money for this. Building, oh, can't see it. There we go. Building Wealth in Challenging Times by Jan Summers. There you go. There you go.
Rich, the other book, which I would also recommend about Jan Summers. Jan Summers has got this Building Wealth, right?
Yep.
The other one, Jan has got this 101 stories. So it
Yes.
actually goes with the case studies.
Yeah.
I mean, the statistics are very old, but in terms of the principles and the knowledge, it's there.
Perfect. Yeah, great. Okay. How does stage 3 tax cuts affect serviceability? Well, if you get a tax cut, you'll just be getting more income in your pocket, which can then improve your serviceability. But it's not going to be dramatic. It will be quite marginal, in my view.
Yeah.
Thanks. Enjoyed the webinar. Rich, you say you borrow as much as the bank will lend you. So question, if the bank can lend me $1 million, should I buy 2 properties at 500 each or one more expensive property? Great question. And that question is really to the cart before the horse. It's something that we would answer as part of an onboarding session with someone. If you've got $1 million, I'll be asking a whole bunch of other questions around your income, around your strategy, how many other properties you own. But Munzrul, do you have a generic answer to that question at all?
Yeah, I probably would take a step back and say that let's go through your individual goals, right? So your smart goals for the future as well as where you are. The generic answer that is that the quality is sort of always comes in with a bit of price, and one takes that into account.
Yeah, for me, I mean, it depends on what stage of your journey you're on. Like for me, I wouldn't buy 2 500s unless I wanted the cash flow. I would tend to buy one $1 million property because I'm going to get pretty similar growth rate and maybe a slightly lower cash flow, but it just would depend on what stage of my journey I'm at. Some second and third tier lenders suggesting buying in a trust structure. They say trust loans do not much impact your borrowing power. What are your thoughts about that, Manzur?
Well, this is a tough one in the sense that I'm seeing so many publication at the moment. Buy it on the trust, you get that sort of the indefinite level of the borrowing and all the rest of it. One got to be careful. Where the rule sort of comes in is that if a trust is a self-sustaining trust, then many of the banks they ignore that particular trust structure, right? But if your trust is self-sustaining this year, it doesn't mean it would be self-sustaining in the future year as well. So you got to be just a little bit careful with this. And the second point is that the banks also change their rules. While they are married to it, be very, very careful how you take this.
Excellent. What is the best state to invest in this year? Well, there's multiple answers to that question. And I think I've already covered it already, is that there's many good states to invest in. There is not one state that's going to be the best. There is several. If you have an insurance claim where they need to replace fixtures, can I get depreciation schedule updated? Yes, absolutely. You can. Yep, 100% correct. Is it better to purchase commercial investment rather than residential? Well, not necessarily. I think both are good. The benefit of commercial over resi is that you get a net yield. So the tenant typically pays the outgoings. So you tend to get a slightly higher net, or not always, but a higher net yield. But I think both are good within self-managed super. What's your thoughts, Manzurul?
Yeah, and the answer is both are good in the sense that, because say one probably argues that residential property, whether there is a bit more growth potential, and if it were to be bought in a self-managed super fund after the retirement, there is no tax.
Yes.
So that means you get bigger return in terms of no tax on the growth. On the other side, I can argue saying that, well, commercial property has got a lot more cash flow, exactly as you said, and the self-managed super fund sometimes gets restricted in terms of how much cash you can put in. And if the cash flow is what you need, then you buy the commercial property in there. Summary of it, I would probably say, of course, it depends on the individual circumstances. But if the interest rate is high, cash flow is a little bit more constraining, can commercial property be on individual name or on trust, as opposed to the super fund becomes a bit more growth asset?
Great pick up there. Fantastic. Can I nominate my rental property as a PPR if I decide to move overseas, if I've ever lived in that rental property? What's your thoughts on that, Manzurul?
Yeah, and we can, right? Like if we can I nominate a rental property as my principal place of residence if I decide to move overseas? No, sorry, my apology. I'll take a step back. The rental property, it can only become a principal place of residence if you are genuinely living in there, right? And the definition of the genuinely living in there means that you are living in there, you're sort of traveling around those places. But if you go overseas, are you going overseas for a month for a holiday? Then, well, it just stays as principal place of residence. If you're going overseas for a backpackers for 6 months or so, then maybe it just stays as such. If you're going overseas for about 2 years of contract, then no.
Good question. As a single person trying to buy a property, is it better to form a company, buy under a trust, or simply under your own name? Well, I think we covered that. And again, the answer to that question on what entity or name to buy it in is going to depend on the individual financial situation. It's not a question you can answer directly on a webinar because it's going to relate to that person's individual circumstances.
Yeah.
Is there a website which can calculate land taxes across different states?
Oh, that's a hard one, Rich, because I'm actually not aware of a website which calculates all the land taxes as such. I would not be surprised if there is some, but I haven't come across, because you're right. It's a good question in the sense that land tax is so different on each estate, and it's also so different in between individual, trust, and so.
Correct.
So the best advice that I do is to go into the Office of Estate Revenue website, and each has its own land tax thresholds and maths.
Yep, that's going to be a good idea for a blog on that one. I might do that. I think we've covered it's not worth buying an NDIS property. House and land package. Oh, I forgot to mention it. I'm not a big fan of house and land packages for a couple of reasons. One is because they're often in an area that's got an oversupply of the same type of property. Secondly, you're paying a retail price and you're not buying it at an established property price. Even though there's great tax deductions because it's brand new, typically they don't grow nearly as well as other properties that are better located. Should I purchase my family having joint names if it will affect purchasing power in the future? What do you think of that one, Manzurul?
Yeah, look, I probably would buy your family home to the partner's name who's got the lower level of risk. So I'll just give an example. Let's say, you've got a gentleman and wife, and let's just say the wife is sort of in a whole bunch of businesses and the gentleman is working in the office. So the gentleman's risk profile is low. On that example, I'll buy on his name. And if it's the other way around, I'll buy it on the wife's name. So whoever is the risk profile is low is what I would buy. I don't think there would be any impact in terms of the purchasing power because it's all been combined purchasing power.
Excellent. How to decide whether to invest under individual, trust, or company? What factors to consider? Well, just quickly, my thoughts on that one, Manzurul, would be if you're in a profession where you're more exposed or likely to be sued or you need asset protection, you'd probably want to consider buying under a trust with a corporate trustee. But if you just really don't have too many issues, you're fairly simple, you might consider a personal name. But your thoughts, Manzurul?
Yeah, all of the above is right. So it's effectively your asset protection. It's your tax planning. It's your land tax. It's your longer term succession as well as the retirement planning, right? So you add away all of those, then you add away the lending behind it, and you sort of say what is right to your circumstances as the time that you are in.
Right. My primary residence is now an investment property. How long can I hold on to it before I can sell it without incurring capital gains tax? My understanding that's the 6-year rule, Munzrul.
That's right. It's that old sort of a 6-year rule which sort of applies. There are some terms and conditions and some provision, but generally speaking, 6 years.
If our investments properties are cash flow positive, there's a tax liability. Do we need to pay PIYAG or can we leave it to the end of the year? Well, you can always leave it to the end of the year. But again, if the time value of money is important to you, or you want to, I would rather get that money in my pocket, put it into my offset account and reduce interest. I'll give you a quick little story about that. When I first started investing in property, Munzrul, I was working as an economist in government and I started to buy a bunch of properties. And I think I bought 3 properties in my portfolio and I'd managed to get my taxable income down to zero
Right.
at the time using the old 221D. And I remember the lady at the HR department went, "Oh, Rich, I've got your pay slip here. How do you get to zero tax?" Like, "Oh, let me teach you about property." And that's partly what sparked me to do my job today. So there you go. So my answer is claim it. Wherever you get it, claim it. I've seen some SMS owners buy caravans for personal use with limited hiring out. Ooh, what's your answer to that one? That's a curious one.
Yeah, no, you got to be careful, very, very careful. And I do apologize. And the reason I say you got to be very, very careful because the self-managed super fund gets audited by the auditor every year. And the risk is that if there is a contravention, it's not so much that the tax rate increases from 15 to 47%. You actually pay 47% on your entire capital. So one got to be careful, please.
Very, very strict rules. How much negative gearing is good negative gearing? Consider the capital growth of 3 to 4% year on year. What do you answer to that one, Munzrul?
A good question in the sense that one can sit down and do a modeling behind it, right? And say that, okay, what's the negative gearing? It's a bit of open-ended question in the sense that what's your overall taxable income? What's the percentage of the negative gearing that you're receiving? Are you sitting at 500,000? Are you sitting at 100,000, right? So the comment what I say is that you don't do the tax effective investments purely because of getting the negative gearing. Negative gearing sort of happens is that as part of the mechanism, if it needs to, as long as there is a growth on the other side.
Excellent answer. Love your answers. 2 more questions. If you purchase under one name, but 2 on the loan, does that mean both people eligible for first home buyers on the 2 homes?
Now, first home buyers it's always on a family oriented, right? So whether it's one name, whether it's a 2 name, it's a family unit.
Got it. We've got time, just one more. If you have borrowing capacity of 2 million, would you buy one blue chip or would you split it up into multiple properties given couple is on a solid income? Personally, I would probably split it into 2. Again, it depends on your style of investing and how many properties you have. But I think if I've got $2 million, I'd probably split it up into two different areas, Munzrul.
Diversification and 2 level of rental return, and the risk is a little bit lower.
Yeah, fantastic. Look, I'm just conscious of time. We did say we'd stop at 1:45, so I'm going to honour that, Munzrul. Can I just say thank you for all of our attendees today for coming on the webinar. Hope you've really enjoyed it, got some good value out of it. We will be sending out the slides and a copy of the recording for those that missed it. Munzrul, hope you've enjoyed today.
Absolutely. It was great. Thank you very much, Rich. Thank you very much for the
Wonderful
opportunity.
to have you on, and we'll be sending out Munzrul's details if you'd like to get in contact. But please, thank you for coming again, and we look forward to joining you again very soon. Bye for now.
Thank you, guys.